Why do banks pay you to keep money, but charge you to borrow it? Imagine a savings jar that slowly grows just by sitting there. That growth comes from something called interest rates. But how do interest rates work, and why do they change over time? They shape your paycheck's value, your loans, and even the prices at the grocery store. Understanding this can change how you think about your money every day. After this, the next time you put cash in the bank or take out a loan, you'll see the invisible force moving your dollars around. What is an interest rate? Have you ever wondered what happens when you lend someone money or put cash in a savings account? The key number at play is the interest rate. Think of it as the yearly percentage that shows how much extra money you earn or owe on top of the original amount. Picture this: you lend a friend $100. You both agree that in 1 year, your friend will pay you back $105. That extra $5 is the interest. It's the price of borrowing your money, or the reward you get for lending it. This rate doesn't just affect personal loans. It shapes the broader economy by setting the cost for borrowing and the benefit for saving. But how does this percentage add up over time? That's where things get more interesting, because interest can build on itself, changing how fast money grows or debt climbs. The next question to explore is how those numbers grow beyond just the first year. How compound interest grows money faster. But this is where interest gets more interesting. Let's say you put $100 into that savings jar, and it earns 5% interest per year. After the first year, you don't just have your original $100 anymore. You have $105. That extra $5 is the interest earned. Now, in the second year, the 5% interest isn't just on the $100 you started with. That means you earn a little more interest, about $5.25, making your total $110.25 by the end of year 2. It's like your money is making money on its own. Over time, this effect becomes stronger. Small amounts can grow into much larger sums because the interest keeps adding up on top of interest already earned. Think of it like rolling a snowball down a hill. It starts small, but gets bigger faster as it picks up more snow. This compounding can turn a few dollars saved regularly into a surprisingly large amount after several years. In fact, before modern capital markets existed, some savings deposits reportedly achieved annual returns between 25 and 50%, showing how powerful compounding can be when rates are high. But there's a catch. This growth depends on the interest rate and how often it compounds. Plus, what if the money you get back isn't worth the same as today's dollars? That raises a question about how inflation changes what your interest really means. That's where nominal versus real interest rates come in. Nominal versus real interest rates, accounting for inflation. Think of it like this. You put $100 in a savings jar that promises 3% interest a year. A year later, you open the jar to find $103. At first glance, it looks like your money grew. But now imagine the prices at your local grocery store rose by 2% during that same year. What used to cost $10 now costs $10.20. That means your $103 doesn't stretch as far as it might seem. You gained $3, but prices went up $2 worth of buying power. Your actual gain, called the real interest rate, is only $1 worth, or roughly 1%. The nominal interest rate is the 3% your savings earn without thinking about how prices rise. The real interest rate subtracts inflation from that number, showing how much your money really grows in value. Ignoring inflation can trick you into thinking your savings are growing faster than they truly are. This matters because if you only look at the nominal rate, you might feel richer when your spending power barely budged. So your money's growth isn't just about percentages. It's about how much you can buy later compared to now. But why do inflation and interest rates change over time, sometimes seeming to chase each other? That leads to the next piece of the puzzle. Why interest rates change over time. You just learned how nominal interest rates differ from real ones by accounting for inflation. Now, imagine how these rates don't stay steady, but shift with the economy's ups and downs. Think back to Germany in the 1920s. Hyperinflation pushed interest rates to nearly 90%. That meant borrowing cost a fortune, and saving was tricky since your money lost value fast. Contrast that with the United States in the 2000s, when rates often hovered below 1%. Low rates made borrowing easier, encouraging people and businesses to take loans and spend. Why such wild swings? Interest rates respond to how strong or weak the economy is, how fast prices rise, and what governments and central banks do to keep things balanced. It's like the dial on a heater that turns up when the room's cold and down when it's too hot. Those extreme cases show how interest rates act as a signal and a tool, rising when borrowing needs to slow and dropping when spending needs a push. But here's the twist. Who controls that dial and how they decide to turn it shapes what happens next. That part, I'm holding back for now. It's the key to understanding why interest rates feel so unpredictable, but actually follow a pattern tied to bigger forces. Central banks and their influence on interest rates. Think of the Federal Reserve, the central bank in the US, as the thermostat for the economy. When things slow down, like a quiet winter morning with empty streets and calm stores, the Fed lowers its federal funds rate, the key interest rate banks charge each other overnight. That makes borrowing cheaper for people and businesses. Here's a simple way. Sarah, who owns a bakery nearby, with lower rates, her loan payments shrink. She feels safe borrowing more. Sarah buys new ovens and hires more workers. That means more jobs and customers around. This extra spending helps the economy warm up. But if the economy gets too hot, with prices rising fast, the Fed raises that federal funds rate. Borrowing costs go up. Sarah might hold off on new loans. Spending slows down, and inflation, the rise in prices you see at the grocery store, cools off. These changes reach your life fast. Your credit card interest can shift. Your mortgage payments might change. Even what you earn from your savings depends on these moves. The Fed's choices work like adjusting water flow in a garden hose, controlling how much money moves in the economy. But when the federal funds rate jumps or drops suddenly, that's when we see real trouble beneath the surface. What extreme interest rates reveal about economic crisis? What happens when interest rates soar to impossible heights? Picture trying to borrow money while the cost to pay it back climbs faster than your paycheck. That's what Zimbabwe faced in 2007. Their interest rates hit 800%. Imagine borrowing $100 and needing to repay $900. Suddenly, loans become far out of reach for most people. This spike didn't just make borrowing expensive. It shouted a warning that the economy was in deep trouble. When money loses value fast, lenders demand huge returns to cover their risk. It's like lending someone $1 today, but fearing it might be worth only a few cents tomorrow. So, the interest you charge must cover that loss, and then some. This extreme shows how risky borrowing grows when inflation runs wild and confidence in the currency collapses. For everyday folks, it means saving jars that once earned a little interest now struggle to keep up. Prices spiral, savings shrink, and borrowing dries up. This isn't the first time high interest rates have marked economic distress. In the late 1970s and early 1980s, Prime credit interest rates in the United States and other countries reached levels higher than any seen since the early 19th century. Those rates reflected deep inflation and economic uncertainty, making borrowing costly for businesses and families alike. Such drastic interest rates reveal how fragile an economy can become, hurting people who rely on loans or even their savings to get by. But what if some ideas about interest rates don't match this reality? How do common beliefs lead to confusion about what these numbers really tell us? Common misunderstandings about interest rates. Interest rates aren't just about banks making extra money. Picture this: lending your bike to a friend. If they're careful and always return it on time, you won't ask for much in return. But if they sometimes lose things or ride recklessly, you'll want more back. Maybe a new lock or extra help with chores. In money terms, that extra is a higher interest rate. Lenders charge more when they think there's a bigger chance they won't get paid back. It's not just about profit. Inflation adds another twist. When prices rise steadily, the money you get back later buys less. So interest rates have to cover that loss. Central banks like the Federal Reserve also change rates to keep the economy steady. Think about a savings jar earning interest. If rates go up, your jar fills faster. But borrowing costs rise too, making it harder to buy a car or rent an apartment. Interest rates reflect risk, inflation, and policy. They move because of real changes around your money, not random chance or greed. But if rates depend on so many things, how do lenders decide what to charge you? That choice isn't simple, and it shapes what your money can do next. Interest rates explain why banks pay you to keep money but charge you to borrow it. They represent the cost or reward tied to money over time. These rates change because of economic forces and decisions made by central banks to keep the economy steady. When interest rates rise, borrowing costs more and saving pays better. When they fall, loans get cheaper, but savings grow slower. Let's say saving $20 a week. A higher interest rate means your savings grow faster. Interest rates shape how your money grows or costs you, reflecting the health of the economy beyond the bank's doors. Simply put, interest rates are the price of time for your money.